It is officially my dividend payday in August, where I will earn $2,364 from 2 dividend stocks. It hits my account today on August 14th. Every single dollar of this is being reinvested to buy more shares in each of these companies. That is $2,009 from Hess Midstream, ticker symbol HESM, and $355 from MPLX. And those are the 2 dividend stocks that I am buying more of in August. These are 2 of my top dividend payers in my personal long-term dividend growth stock portfolio that I update every single month on this channel. I started buying these stocks in 2025, and they've generated solid returns for me so far. HESM has a 25% total return in that time, and likewise MPLX has a 31% total return. But these are very rare stocks in that they have a high dividend yield and high dividend growth. Each of these have 7% plus forward-looking dividend yields, with the dividend growing at a 3-year CAGR of 9.5% and 11.6%. That is a crazy combination of yield and growth. Now you may say, Zach, why are you reinvesting these dividends after the stock has gone up 15% over the past year, sitting near all-time highs? And why are you considering adding even more on top of that? Well, you are right. MPLX stock, it is up 19% over the past year. That's just in the price. And over the past 5 years, the company has traded at a higher historical dividend yield, a median of 8.27% forward-looking dividend yield, and it's currently at a 7.18. So yes, the stock does look more expensive than it has been, but I would argue it's still undervalued. So here's the plan. I'll give you a breakdown of the dividend for both of the stocks. I'll go over the current yield, the dividend growth, the sustainability of the payment. Then I'll do an intrinsic value estimate on the company. In this case, I'll be using the dividend discount model. And at the end, I'll show you exactly what that $2,364 dividend looks like when you reinvest it, and the powerful dividend snowball effect it can have in the long run. And honestly, the numbers will surprise you. With that said, let's roll the intro and get into today's episode.
The following reflects the opinions of a man who spends far too much time thinking about stocks. Please do your own research before making any investment decisions. Nothing in this video is personal financial advice. Continue at your own risk.
My name is Zach. This is Dividend Data. You should leave a like and subscribe to the channel if you enjoy the video. And throughout, I'll be using dividenddata.com, which is the best stock research tool and portfolio tracker for dividend investors. So if you want to track your portfolio and dividend income just like me, automatically link your account and help track your dividend income throughout the year. Right now is a great time to join because we have a 50% off sale where you can get half off annual membership and keep that discount price for life. This is to celebrate the launch of our next generation tool. We call this the Founders Edition. And if the tool helps you find just one better investment or it keeps you more consistent, then it way more than pays for itself. The link is in the description and pinned comment of the video, where you can scan the QR code in the bottom right corner to get access to the sale. So as you can see, this is supposed to be my highest dividend income month, and that is being led by HESM. That will pay me $2,009. And you can see that HESM and MPLX have been responsible for growing my dividend income significantly over the past year. Prior to adding these stocks, I had a 12-month rolling average of about $400. That was my average monthly income. But you can see that has more than doubled and will continue to rise. And both HESM and MPLX are starting to get a significant compounding effect from reinvesting earned dividends and dividend growth. So starting with HESM, I just did a full stock review on this company. I'll link it in the description. So I'm not going to go as in depth as I did there. I think that was like a 20 or 30-minute video. But the key difference I will mention that's more business related here, because a lot of you will have questions about this around taxes with both MPLX and HESM. HESM does go on your 1099 div. You don't have to have a K1 form for that stock. MPLX, however, is a more traditional master limited partnership, and you will have to have a K1 for that stock. I just went through my first tax season with both of them. I have some experience with K1s. I don't find it to be that big of a problem. And I found MPLXs to be very timely and actually well organized. However, HESM, it was still on the standard 1099 div that you have in the US for your dividend income. So that's something to be aware of. And given that fact, it's an extremely rare combination of dividend yield and dividend growth. I almost can't find a comparable stock in the market. So HESM has a forward-looking dividend yield of 7.87%, and it's a quarterly dividend that they raise every single quarter. Over the past 5 years, the dividend is up 56.45%. That is growing at a 9.36% compound annual growth rate. And they've been raising this payment since 2017, and they continued paying and growing the dividend throughout 2020 when many other midstream oil and gas stocks stopped paying the dividend, or at least cut it significantly. You can see their most recent increase was 1.23%, one before that 2%, before that 1.23%, then 2.4%, 3.8%, 1.2%, 2.4%, 2.5%. And the management has put out guidance that they're expecting at least 5% dividend per share growth. That's on an annual basis. However, they've been putting out that guidance this entire time in the past, and they've been beating it consistently. The dividend is their favorite way of returning capital to shareholders. If we look at the yield analyzer for HESM, you can see the 7.87%. It's in the 67th percentile over the past 5 years. So this puts it in fair value range. It's not an outlier to the upside, and it's not the most expensive the stock has been. There's been times where the stock was a 6.5% dividend yield, and even 6% back in 2022. So relative to your other opportunities you could have bought this stock at, it's not dirt cheap, but it's definitely not expensive. The free cash flow payout ratio in fiscal 2025 is 48%, so that is sustainable. However, when I talk about the sustainability of the HESM dividend, there are a lot of factors to analyze with this one. It's a weird corporate structure with a partnership and a public company. Please go watch my full HESM stock analysis video if you want an actual full breakdown. I don't have the time to go as in depth here. If we look at the value graph tool for HESM and we base it on the dividend, the company over the past 5 years has traded at a median multiple of 7.65%. The current dividend yield is 7.87%, so we're still slightly above that 5-year median. And if it goes back to that, that would imply 2.9% upside from here. I personally was loading up on the stock in October and November 2025. As you can see, for me, I have a large position in the company. I am not looking at trimming it. If anything, I'm planning to reinvest dividends and continue dollar cost averaging in over time. I haven't been buying pretty much in 2026 other than reinvesting dividends, but as the year goes on, I'm planning to continue adding. And in the long run, I would like this to be a core part of my portfolio. In recent years, it's had a great total return. Over the past 5 years, it's grown at an 18.5% compound annual growth rate. That's with dividends reinvested, and dividends are a core part of your return here with HESM. So it's not as cheap as it has been in recent history. But if we use our intrinsic value tool for HESM and we do the dividend discount model, I'll show you that it's still pretty cheap. So this pre-fills with all the related stock data for the company. And the dividend discount model, we're basically projecting out all of the future dividends that the company will pay you, and we're discounting it back to today. So I like to be pretty conservative with this, so I'm going to lower this to the downside. You can see it's showing it's very undervalued. But that's assuming a high rate of dividend growth and a 10% required return. So I'm going to lower this down to 5%. I'm going to change the projection to 30 years because some of these oil and gas assets, it's hard to tell what it will look like 50 years from now necessarily. So assuming 5% dividend growth rate and a 10% required return, that gives an intrinsic value of $49.92. And this is just valuing the company based on the dividends it will pay you. So it's a very conservative way of valuing the company. But I like it for these high yield midstream oil and gas stocks. So this shows 24.5% upside from here. And let's say you want a 13% required return. That would give it an intrinsic value of $36.89. So a little bit of downside if you want a higher return. But if the dividend growth rate ends up being higher, which it has been in recent history, if we up that to 6%, you can see it's right around fair value. And if it's at 7%, then it is undervalued. Again, you can see over the past 5 years, it's been growing at a 9.36% CAGR and up 7% in the past year. Now, the second stock I'm going to be sharing is MPLX LP. This is a limited partnership. You get a K1 for this one. But I find this company to be incredibly attractive. I just did a stock analysis video on it as well. I own less of the company, so I'm only getting a $355 dividend. This is a larger and more diversified company than HESM. HESM has even more customer concentration risk, and I believe was an $8 billion market cap. This is a $60 billion market cap. And you can see over the past 5 years, the price returns 107%. The total return in that time is 221%. That's 26.35% compound annual growth rate. MPLX has a forward-looking dividend yield of 7.18%. And this company has been a dividend growth machine. They were raising it every single quarter. And then in 2020, they kept it flat for a little bit. And then they went to annual raises on the quarterly dividend. And they are due for their next dividend increase. And you can see in recent years, the dividend increase has been very high. The prior one was 12.5%. The one before that was 12.5%. The one before that was 9.6%. And here's the thing. I do my research. I listen to their latest earnings call. The CEO on the earnings call said that they're targeting 12.5% this coming year and 12.5% in the year after that. And that the goal after that period is continued high dividend growth. Now, I personally am not expecting 12.5%. And if they hit that, I think the stock is pretty undervalued right now. And I think it's attractive even with lower dividend growth. Now, right now, we're on the lower end of the past 5 years of the dividend. It looks expensive for HESM. We're in the 7th percentile, so we're on the low end. The median dividend yield has been 8.27%. The payout is sustainable, has a 98% free cash flow payout ratio. Again, with these midstream oil and gas stocks, I actually wouldn't be looking towards free cash flow or earnings per share payout ratio. These companies report distributable cash flow as one of their metrics, and that's how they base a lot of their dividend payment decisions. But just so you do have an idea, the earnings payout ratio is 81% as of fiscal 2025. And no matter what way you look at it, MPLX stock has been going up. The stock was incredibly undervalued on pretty much all financial metrics, trading at very low multiples. So even though the business has grown in recent years, they got re-rated upwards a little more. So based on its median multiple over the past 5 years, it looks expensive based on that median multiple. But it's still a 12.89 P ratio over the trailing 12 months. Median in the past 5 years is 10.9. Looks expensive based on the dividend as well. Same thing, the median is much higher over the past 5 years. However, one factor to consider here is that this is not counting their coming 12.5% dividend. Now, that's not declared yet. That's what they said, though, on the earnings call. So the actual forward-looking dividend is higher than a 7.18% yield. And if we do the dividend discount model for MPLX, again, it pre-fills with all of the related information. A lot of what I'm showing you, by the way, is Pro Tools over at dividenddata.com. Again, we have our 50% off sale. Click the link in the description and pin comment. And this is pre-filling to a pretty high dividend growth rate because it's been growing high. For MPLX, let's put it at 7% dividend growth. Again, let's adjust to 30 years of projections. And this is just to be conservative, the lowering the growth in the projection years. With a 10% required return, the intrinsic value is $86.66. That'd be 44.5% upside from here. With a 13% required return, that would give an intrinsic value of $61.90. That would be 3.28% upside from here. Now, if we lower the dividend growth rate to 5%, you can see it's a little overvalued, intrinsic value of $50.32. And again, this is valuing the company only on the dividends or the distributions they'll pay you. However, if we want a 10% annual return and 5% dividend growth, which is pretty conservative considering they're going to hit 12.5, that starts to give you a pretty good buffer. That's an intrinsic value of $68, 13.6% upside from here. And when I was covering my MPLX stock analysis video, I was actually getting a little more bullish on the company. I think it's still pretty attractively priced. So of the two I'm showing today, especially since I already have a massive stake in HESM, I'm looking more to add in MPLX with new added money. And in my personal dividend growth stock portfolio, I look at these two as the core income pillars that I'll be building in the years to come. Now let me break down the actual impact of these reinvested dividends, how much shares I'll be getting based on these dividend payments, and then I'll walk you through some of the early compounding effect of reinvesting dividends in the year or so that I've owned the positions. And then I'll forecast just what this dividend snowball effect looks like on my overall portfolio in the long run. So HESM, I'm getting $2,009. I will be reinvesting all of that to buy more shares. Today's share price at the time of recording this video is $40.08. So as an estimation, if I reinvested dividends at that price, it would earn me 50.13 shares in HESM. With no future dividend increases, that increases my next dividend payment by $39.60. But the reality is there will be another dividend increase. I'll be reinvesting that dividend as well. And you start to see the compounding effect that has over time. I already have 102.17 shares of HESM from reinvested dividends. That's valued over $4,000, and it's paying me an increased amount of income every single quarter, which adds to that reinvestment. and it's about to go up by 50 more shares. That is capital I didn't add to this company. I'm just reinvesting the distributions the company pays me. With MPLX, I'm getting $355.39. At today's $59.94 share price, that will get me 5.92 more shares of MPLX. Before the upcoming dividend raise, that's giving me another $6.40 every quarter, $25 a year. That's more money than I'm reinvesting, and this happens 4 times a year. And then on top of that, we have dividend growth. I already have 16.45 shares from dividend reinvestment. That's nearly $1,000 of value. And if we use the forecast tool on the portfolio tracker, this will give you an idea of my overall portfolio as we forecast the compounding of stock price appreciation, dividend growth, dividend reinvestment, that whole dividend snowball effect. So I'm just going to make some changes here. We're going to move dividend growth down to 7%. We'll move price appreciation down to 9%. We're going to assume I'm contributing $2,000 a month. That's kind of what I'm doing, and it's going to go up over time. And let's say I want to hit a monthly dividend income goal of $5,000 a month, and I'm reinvesting dividends in this scenario. So here you can see a projection tool. It gives you a 5-year look, a 10-year look, and an all-time look. You can set a portfolio value goal, a monthly income goal, and it gives you an estimate of what year you're going to hit that goal. And that's based on a bull case, a base case with contributions, a base case without contributions, and a bear case without contributions. So in this base case with contributions, right now I'm looking at the dividend income over the next 10 years by the end of that time. So this would be just my entire portfolio, reinvesting dividends at those assumptions I gave. My overall portfolio would be paying me $4,000 a month on average in dividend income. This is much higher than my current one where I have that one outlier month with $2,300. And then my other months are closer to $400. So you're not at that $5,000 a month goal yet, but that happens in year 12 in this scenario. And then after that, the compounding effect just starts to get larger. By year 20, I'd be getting $12,000 a month of dividend income. And personally, I'm not going to be done working then. I'm pretty young. So I'm going to be reinvesting all of those dividends unless I choose not to. And that's when the compounding really picks up, when you're reinvesting massive dividends year after year, month after month, increasing your ownership stake in these companies. And you can see just 5 years later, your dividend income would be $20,000 a month. And 5 years after that, $33,000 a month. And even in the bear case scenario where I'm not adding any new capital and we're basically just assuming dividends reinvested, 7% overall dividend growth, 9% price appreciation on my entire account, you would cross that $5,000 a month dividend income goal in year 22. And again, this is coming from the scenario where my 2026 dividend income monthly average is $1,050. You can see that right here. So those are my top 2 stocks that I am buying in August 2026. They are my high yield compounders. I'm reinvesting those earned dividends. If you found this video to be interesting, make sure to leave a like, comment, and subscribe to the channel. And if you want to track your portfolio like I do and research stocks the same way I do, the same exact tools, head over to dividenddata.com. There's a great community of investors, all with a like-minded strategy. And the product just keeps getting better every single week. It's pretty awesome. Link is in the description and pinned comment. And with that said, I'll see you in the next video.